What's up guys, Hamilton here, and today I want to talk about Twitter, the stock, not the platform. Could the company be positioned for a turnaround, and what's the stock likely to be worth? I'm going to share 4 reasons why I think Twitter stock could outperform in 2021. Let's dive right in. Welcome to the channel. If you made it this far, I've got a favor to ask. Please smash that like button. It's a little effort on your part, but it goes a long way to helping me grow this channel. That out of the way, let's talk stonks. I'm going to be honest here, guys. I've had a Twitter account since 2011, and I only started tweeting in 2021. I know I was late to the party, but if we compare Twitter to other social media platforms, Facebook, Snapchat, TikTok, etc., they've all had a pretty solid run. Great user acquisition and monetization strategies, and they've done very well out of it. Whilst Twitter, on the other hand, kind of fudged it, and its market cap tells the story as such. Right now, Twitter is worth around $57 billion compared to Facebook's whopping $770 billion market cap and Snap's $93 billion market cap. Damn, even Pinterest is worth over $50 billion. If you're a Twitter user, ask yourself, when's the last time you clicked an ad? The platform hasn't lent itself well to advertisement historically, and management's execution has been poor. And the company has been slow to develop a solid strategy to monetize its platform and grow ad revenues. That is, until now. The winds are changing for Twitter, and it seems management is getting serious about revenue. Which brings me to the first of 4 key thesis points. Point 1. Twitter is at the beginning of a multi-year turnaround which is still very much underappreciated by Wall Street. Management has a renewed focus on monetization and is launching new products to a 30% larger user base as of Q3 2020. Having come under a lot of scrutiny, Jack Dorsey may have finally succumbed to shareholder pressure to better monetize the platform. In January 2021, Twitter announced the acquisition of Review, a Dutch startup that enables users to publish and monetize email newsletters, shining a light on plans to take on Substack. It's a small acquisition, but an important one because it hints that Twitter will offer premium services to content creators, which is important for the future growth of the platform. Enabling content creators to monetize their content and grow their user base is vital for attracting creators. It's not just Review. Twitter has launched a series of new features including fleets, carousel ads, and spaces, that last of which could signal massive upside opportunity. Spaces is Twitter's audio play, and right now social audio is a nascent market opportunity with no clear winners. Sorry, Clubhouse. If Twitter can win in this space, pun intended, it could add tens of billions to their market cap. That aside, Twitter still has plenty of runway for growth, especially on the international side, and global engagement per user is up 16% year on year overall. Point 2, activist involvement means limited downside. Twitter underwent a wave of board changes in 2020, introduced a staggered board structure, and announced up to $2 billion of buybacks, which they've already demonstrated their willingness to deploy post-stock drop. Point 3, estimates are too low. With revenue growth accelerating over the next 6 months, consensus may be too low, which we've already seen after their most recent earnings announcement. As of September 2020, Twitter was growing an average daily advertising spend by 19% year on year, versus the street consensus which modeled decelerating aggregate. Based on what they're doing, I'd expect Twitter to sustain a 20% year on year revenue growth rate into 2023 versus the street modeling a deceleration down to 12%. Point 4, multiple re-rates as growth initiatives gain traction. As more and more data hits the street, we can expect multiple analysts to re-rate Twitter as a buy as they revive their earnings estimates and price targets upwards. Bonus point, Twitter is a post-recovery play. Most ad revenue comes from big brands, so Twitter was hit hard in 2020 by the decline in ad revenue, but 2021 recovery in ad spend is going to give it the best comparables possible. Especially in the back end of 2021, if travel rebounds, Twitter will benefit disproportionately compared to Facebook and Pinterest. I've said this before regarding Spirit Airlines, but it's important to note. The optics of stocks hit hardest last year is going to give them a massive boost. If revenues were down 50% last year and they come back to normal, you're going to see headlines like Twitter reports 100% revenue growth in Q1 2021, and these headlines create FOMO as retail investors rush into the stock on the news. Add to this the cyclical nature of ad spend, and Q1 revenues could come in hot. To summarize, we have a stock that's been a chronic disappointment post-IPO, activist involvement at board level, structural shifts in business model, and earnings set to beat consensus estimates. All in all, I think Twitter could easily be a $100 stock, and with Investor Day just around the corner on the 25th of Feb 21, I think we'll see more analysts wake up to the fact that Twitter is undergoing huge structural changes that'll support strong revenue growth into the coming years. Just remember to buy the dips, not the rips. And that's all from me. As always, this is not investment advice and blah, blah, blah. Oh, and please smash that like button and comment below to help me grow the channel. That's a wrap.